Imagine this. You have cleared the written test and then you enter the interview room confidently. The interviewer asks just one simple question. What is the difference between a provision and a reserve? You hesitate, 10 seconds of silence, and within those 10 seconds, your chances of getting the job start disappearing. Why? Because accounting interviews are not about remembering definitions. They are about proving that you understand accounting concepts. Hi everyone. Welcome back to InfoCraze. If you're preparing for an accounting interview or planning to build a successful career in finance, make sure to subscribe to the channel and press the bell icon because we bring practical, industry-focused videos that can help you stay ahead of the competition. Now, in today's video, I am going to reveal the most frequently asked accounting interview questions in 2026. These questions are asked in interviews for accounts executive, accountant, senior accountant, finance executive, tally accountant, and even many MNC finance roles. So, without wasting any more time, let's get started. Question 1. What is the difference between capital expenditure and revenue expenditure? This question eliminates many candidates. More than the textbook definitions, the interviewer generally wants to know whether you can correctly classify expenses. Here's the simple way to answer. Capital expenditure is the expenditure incurred to acquire, construct, or extend the life of a long-term asset. Economic benefits arising from such expenditure extend beyond one accounting period. Therefore, it is capitalized and shown as an asset in the balance sheet. The key words in this definition are, economic benefits extend beyond one accounting period and shown as an asset in the balance sheet. Examples of capital expenditure are buying machinery, buying office furniture, constructing a factory building, or major improvements that increase the useful life of an asset. Now, revenue expenditure. It is the expenditure incurred in the normal course of business to operate and maintain the existing business and its earning capacity. The economic benefits arising from such expenditure are consumed within the current accounting period, therefore, it is treated as an expense and charged to the profit and loss account. Examples of revenue expenditure are salary, electricity, and stationeries. Question 2. What is depreciation? How is it different from amortization? Depreciation is the systematic allocation of the depreciable amount of a tangible fixed asset over its useful life. It represents the reduction in the value of the asset due to wear and tear, obsolescence, usage, or the passage of time and is recognized as an expense in the profit and loss account. Instead of charging the entire cost of an asset in the year of purchase, its cost is allocated over the years during which it helps generate revenue. Amortization is the systematic allocation of the cost of an intangible asset over its useful life. Examples of intangible assets include software licenses, patents, copyrights. Question 3. What is deferred revenue? Is it an asset, a liability, or an income? Deferred revenue, also known as unearned income, it is the consideration received from a customer in advance for goods or services that have not yet been delivered or performed. Since the related performance obligation has not been satisfied, it is recognized as a liability until the goods are delivered or the services are rendered. Let's take an example. Suppose a software company receives 120,000 rupees on the 1st of April for a one-year software subscription. At the time of receipt, bank account debit 120,000 rupees, deferred revenue account credit 120,000 rupees. The company has received the money but has not yet earned the revenue. At the end of a month, as the service is provided. Deferred revenue account, debit 10,000 rupees, service revenue account, credit 10,000 rupees. Now the revenue is earned and can be recognized in the profit and loss account. So, at the end of the first month, rupees 1,10,000 will be lying as deferred revenue in the books of account. Question 4. What is CWIP? Where does it appear in the financial statements? CWIP, it refers to capital work in progress, which represents the capital expenditure incurred on assets that are still under construction or installation, and are not yet ready for their intended use. Since the assets are incomplete, these costs are accumulated as capital work in progress until the asset is ready for use. In the balance sheet, CWIP is presented under non-current assets, generally as a separate line item under property, plant and equipment. Once the asset becomes ready for its intended use, the CWIP balance is transferred to the relevant fixed asset account. Question 5. What is the difference between bad debt and provision for doubtful debt? Bad debt. It is the amount due from a customer that have become irrecoverable and is written off, because there is no reasonable expectation of recovery. Provision for doubtful debt. It is an estimated amount set aside to cover expected losses arising from receivables that may become irrecoverable in the future. Thus, bad debts represent actual losses on receivables that are written off, whereas provision for doubtful debts represents an estimated future loss on receivables that may become irrecoverable. Hope you have understood the answers to these questions. If you have any question, please put your query in the comments section. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. Thanks for watching.